I think
actual
at the level that these players are trading at, the reputation Jane Street has, to me, it could be, but it just seems to me much more likely that this was something done in a coordinated fashion. Look, at the very highest level, I have always believed that Trump or someone in the administration has gotten to the banks here in the United States and said this needs to end. That this worked when the West was in control and financial assets in the West is what everybody wanted. And it's not happening that way anymore. We're seeing, not only are we seeing the professionals and the institutionals shed equities, where from March 4th to 11th, I believe, was the largest selling by the institutionals of S&P futures ever, or real close to it. So the insiders are selling equities. At the same time, we see Treasury yields rising as bonds are being sold. So I think it got to the point and the realization where they said, we're going to let gold and silver find price discovery for different reasons than we've always tried to hold them down. This is my own theory, right? And so we need to get on sides, and it's not easy to get on sides to the level that these banks were net short. It would serve many purposes. It would serve a purpose of being who is standing for delivery, who is pulling the metal off of the exchanges, who is standing for delivery for 8,700 silver contracts so far in March, over 8,700, or 43 plus million ounces of silver. So it allows them to deliver at low prices, cover shorts, and be positioned as sentiment or open interest is as low as I've ever seen it. That's the exact condition that you would want for a springboard for much higher prices. But in order to ever get to that position, you need to get the banks on sides. And I was doing an interview with Andrew McGuire today. He said, yeah, the banks are neutral right now. They are not really short at all. So is that what they were trying to do? I do believe it is. And because you can't let metal go higher with a state-sponsored price floor if you're fighting against your own banks. It ain't going to work. And I think there was some sort of an agreement made. The West was always trusted. And you can feel the West isn't trusted anymore. The Treasury Department just came out and said, we're insolvent. We're insolvent. We've been saying that for a long time. They said we have $6 trillion in assets, and the number they use is way under what it should be. It was 70 or 80 trillion in liabilities. The unfunded liabilities alone are over that. But look, we're insolvent. We go around the world with a stick. A lot of countries question our behavior. We have weaponized the SWIFT market, the Treasury market. We have fiscal irresponsibility. And then you see shenanigans in the Western markets, like we saw in the LME with copper, like we saw with nickel. You see it 4 times. There have been glitches, 2 to the up, 2 to the down. The circuit breakers broke. And what does a country like India say? We're done using the Western system. As of April 1st, they will no longer use the London benchmark to set their gold and silver prices for their ETFs. They're going to use their own price of their own exchange in India. That's going to happen. You're going to see more of that stuff happening. I have argued for a while that these countries that have been trusting the West forever do not trust us anymore, and they are using our own stupidity against us by draining the system using our own prices. Now, it's interesting because as I talked with you about forever, the BRICS are making a precious metals exchange, and they are doing this to go along with and integrate with Shanghai, with Dubai, with St. Petersburg, with Moscow, with Singapore, with Brazil, with India. They'll all be integrated. They're all going to connect. But I go back to what the gentleman who's building the BRICS Grain Exchange said. We produce and consume more wheat than they do in the West. We cannot control price. That's done on COMEX. But with the development of this new exchange, that's going to change. And it will, just like it will with the metals exchanges. The problem that people have when analyzing this, Michelle, is the way that these players do things is genius. Actually, they do it in a very methodical, drawn-out fashion so as not to be right in your face, even though it is if you look, but not. People say, why not just drain the exchange, give them $5 trillion and just take everything? Well, just like that, they would blow everything up. Call force majeure, not going to happen. The exchanges would freeze and halt, and they would cut off their nose to spite their face. So instead, they have just been draining and draining and draining and draining and draining by a million paper cuts. And at the same time, trust is eroding, and you can see it.
Yep.
By how much now? Look at what France just did. France demanded back the rest of their silver from the United States, right? From the New York Fed. And instead of having the bar shipped, which they would have done, which they should have done. Instead, the U.S. printed the money, gave it to them, and the excuse was France just wanted to have pure bars that met current purity standards. So we didn't take the bars that, supposedly the bars that they would have had would be from coin melt, right? When they melted down all the coins prior to 33, that's what our bars are supposed to be. They're not pure because of that. And well, we just said, let them keep the bars. They gave us the cash, and we bought the pure gold bars in France. Well, all I'm simply trying to say is that whether it be repatriation by central banks, buying by central banks, buying by sovereign wealth funds, draining of the world's exchanges, the trust is leaving, and it's probably already gone. And I think that's why one of these days, this last one maybe being the last one, maybe at least of that magnitude, a system that relies on trust has to back it up. And when you can't back up trust and you keep disrupting the market through glitches, through halts, through absolute unbelievable nonsense, and then allowing things like this, where there is a fine line between conspiracy and reality, where half the world thinks Jane Street did this to bail out the banks and the CME, at some point people just say, screw it. Like India just said, we're not going to use the Western system.
I don't think what we saw is what I would call normal in any respect. I mean, what we saw, first of all, according to the Bank of International Settlements, was structural, not fundamental. They blame it largely on the massive influx into levered ETFs that had to be rebalanced in January, and margin increases, both of which we've talked about an awful lot, but they both coincided together. To me, you have to understand that gold and silver coming down changes nothing. It's the same game it's always been, only this time it was much bigger than we've ever seen, where paper markets push price around. But the important caveat is that at the same time, strong hands are accumulating the real metal. So depending upon how you look at this, lower prices, to many people's opinion, is not weakness, it's an opportunity. It's accumulation, it's positioning. It's also important to remember that for every buyer, there's a seller, or the other way around, really, for every seller, there's a buyer. And the buyers of this panic, I guess you could say, are the smart money traders, the professional traders, the people who understand the fundamentals haven't changed. The BIS told us that. Structural, not fundamental. And this is you could call it a sentiment reset to build the fuel for the next leg up. And we'll talk about the deliveries and the deliveries into China and the deliveries on COMEX and all of these things. But in terms of the price and the price increasing, sure, it's what people notice. It, to me, is really secondary to anything. I look more at the accumulations, which will talk about the future price. But look, if we want to focus on price, I think we can say that the options are expiring, I think, tomorrow. It's the end of the quarter. We're very close, I think, to the end of this drawdown. I really do believe that. I do think we're at the end of it, and I think things will turn. But volatility is something that must be, I think, expected. I would tell you that this last collapse, Michelle, to me, seems very different than any that I've ever seen in the respect. It just reeks of trying to get the banks back on side, as we've talked a lot about, where on the March 20th Commitment of Traders report, JPMorgan closed 633 short contracts, or 3.165 million ounces at the very, very bottom, where Ed Steer is saying, the commercial banks have their lowest short position in silver ever, and close to it in gold, where the banks, I think, use this last drubbing to get on sides, to cover short positions. And here we are looking at the deliveries in March so far. Deliveries in March so far, as of 2 days ago, 12,532 gold contracts. That's 1,253,200 ounces of gold. Let's just do the math just for the heck of it, just to get the scope of how big that is. 1,253,200, let's just call it times 4,400. That's $5.5 billion worth of gold that's been delivered. And 8,713 silver contracts times 5,000 is 43,565,000 ounces of silver. Call it times 73, almost $3.2 billion. So all in,
7, 8, $9 billion worth of metal has been delivered in March as the price has gotten destroyed. That betrays the price action. So I think price is a tool of misdirection. People focus too much on it. Take a step back, remove the emotions, and look at the actions of the most well-informed traders on the planet. And that will tell you where the price is ultimately going. As I said on your show a week or so ago, they asked Wayne Gretzky, "How are you so good?" He said,